Hi, I'm Andrew Berman from the Mortgage News Network. We're here in Atlantic City at the Northeast Conference of Mortgage Brokers and Mortgage Professionals. And here's a man who needs no introduction.
Hey, how are you, Andrew? It's great to see you.
My good buddy Barry Habib for MBS Highways. Barry has been committed for decades now.
Pretty much committed.
Yeah, committed.
Period.
That's true. Many would agree with that, but committed to helping mortgage professionals make decisions for helping their borrowers make decisions on almost when to time the market. I mean, isn't it pretty much?
Well, yeah. I mean, an overall view on the market regarding real estate, interest rates, what's going on. So we try and take a look at the overall situation between the Fed, between the bond markets, real estate markets, and advise our clients accordingly as to what posture they should take.
So that being said, what posture should they take? And give us actually, a longer term view. And so here we are towards the tail end of 2016. What does 2017 look like for us? Should we be scared?
Well, there's always things that could happen. I think that a recession over the next couple of years definitely has a good possibility. But a good place to be would be in mortgage and real estate, because real estate prices tend to hold up well and mortgage rates tend to decline at that time. That said, right now over the short term, it looks to me that interest rates are going to move higher. And we say that because of a few things. We've got some global inflation, especially in the UK, which is causing their bond yields to rise. Competitively, ours are. I think many of the central bankers are realizing that negative interest rates is a stupid idea. So we're seeing more of a gravitation back towards zero and a normalization there. So that doesn't mean rates go much higher. It just means that they don't really go much lower. Now, I think over the short term, we see interest rates move up about 0.25%. We may get a reprieve when the Fed hikes rates. It's counterintuitive, but every time the Fed hikes rates, stock market doesn't like it. Mortgage rates tend to move lower because the stock market sells off and money goes into the bond market. So end of December, after December 14th, if there's a rate hike, I think there's a 2-to-1 chance that there is, you'll probably see mortgage rates decline. That said, to answer your question about 2017, very good year for real estate in most markets around the country. Economy probably slower. Stock market, I'd be a little fearful. And real estate and interest rates, probably the most important for all of us, are good, but higher than what we've seen. So your refinance activity probably slows, but your purchase activity, if you focus on purchase, should do very well.
So in this morning's presentation, you talked a little bit about the tulip mania concept, and are you going to see that happening in a regional on a regional basis?
Well, I think we kind of use that analogy with what's going on in the bond market, and Peter Bookvar, one of the most respected men in the financial world, he and I, when we spoke this morning, Peter used a term of a bond bubble. Yeah. And is there a bond bubble, and could rates go much higher? I mean, it's possible. I don't think they go much higher. I think we both agree that they go higher. But a bubble-like situation, could it be possible? It's possible, because you have to think, when the real estate bubble hit, that's a $10 trillion market, and we know the impact. Yeah. Stock market bubble hit, that's a $20 trillion market. When that hit, the bond market is $40 trillion, so it dwarfs all the other markets. And when you think about a quarter of that 40 trillion is negative interest rates, and would negative interest rates be able to survive or stick around if central bankers are moving towards zero? I mean, you think about negative interest rates. Imagine if you wrote with your own money a mortgage for someone, and you gave them your money, and then every month you said, hey, I'm sending you a payment on top of it. Who would make that bet? You make that bet because you think that that bond, although you're paying interest on it, would have capital appreciation. How does it appreciate? If interest rates go further still, you can write a mortgage at 3%. If rates go to 2% and you've got a 3% mortgage that you're holding, that you're receiving payments on, that goes up in value. If rates go to 1%, it goes up further. So theoretically, you can write a mortgage or a note or a bond at -1%, and even though you're paying on it, make a lot of money if yields go to -2 or -3 if you're holding -1 because it's worth more. The thing of it is now central banks going back towards zero, a lot of this debt is negative. Could there be a bond bubble where people start to sell and unwind this? It's possible. It can be scary. I personally think there'll be a more orderly unwinding of it, and it just means rates go up a little bit, not dramatically.
So listen, considering everything, your members pay a subscription fee to get some great information and really know what to say and how to say. What are you telling your members? And I know this is membership has its privileges, but if you could share with our audience, what are you telling them right now to inspire their borrowers to get off the fence and take action now?
Well, you bring such a good point, because borrowers have become, and potential buyers have become kind of immune, and they've been lulled into sleep. Look, this bond market bull market in bonds has lasted 35 years. People are accustomed to rates just going down, 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 down. So a couple of things. Number one is, when you tell people what rates are, you say like 3 3/4, they go, "Oh my gosh, that's high," which is crazy for anybody who's been in this business for a long time. Yeah. But look, rates are going up. Rates are going to go up a little bit through 2017. They're going to go up between now and the end of the year. So take advantage of what's out there right now. I know rates have gone up lately, and we've given our subscribers that advice that rates were going up. Sure enough, they have. However, don't think that just like the other times it's going to come back down. This time is different. Rates are going to go up. Be cautious, take advantage, get your customers off the fence and into application now, especially on refinances, because they can save a lot of money going forward.
Fantastic. Barry, thank you very much. Now I'm Andrew Berman from the Mortgage News Network. Thank you for watching.
This is Mortgage News Network.